Lesson 21-1 is on accruals. Accruals are a little bit different than other ones because you have got interest that can be earned in one fiscal period, but it's not paid until another one. And so you will deal with accruals, which are like adjusting entries, because it's going over two different pay periods or two different fiscal periods. And so you will be recording them and then you will be reversing them when you get into the new fiscal period. And it's like doing adjusting entries. And these can be ones that are income that you receive, or maybe it's a notes payable that you are going to be paying. And so we'll be doing recording of accruals and the reversing entries in this section. Accruals, examples, it says in here that it is cash that is paid, expenses that have happened before the actual cash is paid is called an accrual. Examples can be interest income. It's earned every day, but it's recorded only when the interest is actually received. A notes payable that you have, you accrue interest every single day, but the note is outstanding, but the interest is not paid until the note's maturity date. And that might happen over two different fiscal periods. And so you will record them as accruals or reverse them as we go through on some of these other ones on here. And here are examples. You've got revenue or expenses recorded at the end of the period. Cash is received in a future period. That's an accrual. Deferrals are the opposite. This is when you've got receipt of cash before the actual revenue is earned, and that's called a deferral. Rental income is received before it is earned. Rent expense is paid before it's incurred. So there you've got a deferral. Cash is received before it is earned. Okay? And so you'll make adjusting entries at the end of a fiscal period to put that information into where you actually are earning it. And then when you get done after that period, generally like at the beginning of January, then you will reverse that entry to put that information back in. So when you pay it or receive the interest, it is clean at that point. And here is a case in point. You've got interest income right here. Notice you got $175 that you are decreasing on interest income, and then you are reversing it on there on the interest receivable. You are reversing that one on here. And so here's one of these adjusting entries for reversing it. If you look at this, up at the top would be your adjusting entries that you did at the end of December. It's just got the 31st. You need to record interest receivable at 175 and interest income, so that's going to be a credit, 175. You haven't received that money, but you've earned it. You need to go back. Now we're down in January 1st. You are reversing what you just did up there. You are going to write the heading. Notice it says reversing entries. And here you're reversing the exact adjusting entry that you did in the end of December. And here's your interest income and your interest receivables. Here is a notes receivable that you've allowed a customer to have. January 30th, you received cash for the maturity value of a 90-day 7% note. The principal is $15,000 plus interest of $262.50. The total amount you're going to receive is $15,262.50. To calculate, and I've already got it calculated here, you're going to take the 15,000 times 0.07 times, it's a 90-day, so you're going to multiply times 90 days and divide by 360, and that will get you to $262.50 as the actual interest. Here is the entry. You received cash in the full amount, $15,262.50. The notes receivable is decreased because they're paying that one off, so it's decreased by the 15, just the principal amount. You then have the interest income of $262.50. Here is the recording of it in the cash receipts journal. Here is your debit, with the credit for the notes receivable and the credit for the interest income. And here is your debit for cash for the total of both. Okay, looking at accrued expenses. They happen in one fiscal period but are not paid until a later fiscal period is called an accrued expense, because there can be accrued income and accrued expense. At the end of a fiscal period, an accrued expense is recorded by an adjusting entry. That adjusting entry increases the expense account, and so you're earning the expense in the proper quarter, but you're not receiving the money until the next fiscal period. So you'll do an adjusting entry. Will also increase a payable account. And so this is what you're doing one fiscal period versus another one. Okay. Here's where we have accrual interest and adjustment. You have a principal of $160,625.67. The interest rate is 8%, and you're borrowing this money. The fraction of the time is for 30 days. So you're going to multiply times 30 and divide by 360. Remember, we don't use 365, it's 360. So the annual interest expense is $710.84. Here is a long-term notes payable. So it's a little bit longer. It's 30 days out of 360 days of the year. And you are going to record this. The interest payable, you're calculating the amount of interest, is going to be a credit to interest payable. And you're going to debit the interest expense for the amount of interest that you have calculated right here. Here's what you've calculated. The principal times 8.08, and that's always stated as a year, and then you're having it for 30 days, divided by 360 gives you this amount right here. This is the interest expense. You're going to credit the payable, and you're going to debit the interest expense. Here's what you're looking at in your unadjusted trial balance. You don't have anything in interest payable. This is the end of December. Your notes payable is 106. Here's that note that you are responsible for. And the interest expense for a variety of other places is $17,636.26, not just related to this. You just calculated an adjusting entry. The interest expense is $710.84, and the interest payable is the same amount, and that's what you just calculated to do an adjusting entry. You haven't paid this yet, but you have to record it in the month or the quarter that it is, or the fiscal period that it is earned in. Reversing. So when that fiscal period is done, so now you start in January, you've got to reverse what you just did, and you're going to do a reversing entry. And you just did this as an adjustment. You are going to reverse it because you haven't paid it yet. And it will be messed up if you don't do a reversing entry. It won't be accurate. You're going to write reversing entries, put the date, and this is going to be January 1st. It's the first adjusting entries you do in January. You reverse what you just did at the end of December to put it back in, because you will pay on this one and it will be accurate in this year. So you're just reversing what you just did. Okay? Here are the effects of not using reversing entries. They are not required in accounting. You don't have to do them. A company can choose to use reversing entries or not. Choosing to make reversing entries prevents double charges, which can be confusing. Reversing entry is used whenever an adjusting entry creates a balance in an asset or a liability that initially had a zero balance. Okay? paying an installment on a notes payable with accrued interest. So now you're going to pay some of this off, and you're paying off in installments. You pay the cash for the monthly payment of the long-term notes payable. This is how much you're paying, plus interest of $710.84. You're figuring that out for one particular month. And here is, you're going to add these two together, you get $2,433.17. Here is the amount that you are paying minus the interest expense, which they calculated and you calculated, is the reduction in principal. So the principal is reduced by this much every month. And here is your cash payments. Here is the notes payable. This is a liability. You are doing a debit. You're reducing the amount that you owe by $1,722.33. You're paying interest of $710 each month, and your total cash is $2,433.17. Here's analyzing these accruals. The adjusting entries for accrued revenue and accrued expenses must be recorded at the end of a fiscal period. So the end of December is usually when you're going to do it, in order for the fiscal statements to be accurate. And you can do it every single month. Most of them do it at the end of the year. Each accrual entry affects a balance sheet balance on an income statement. So the balance sheet and the income statement are both affected. If the accrual entry is not recorded, both the balance sheet and the income statement are incorrect. You don't have to do these entries, but they are incorrect, and it's not accurate, and that's what you want to have accurate, so you can show the accurate net income or net loss and pay accurate taxes. You might be overestimating your income and paying more taxes than you need to. And so you want to have paid just the amount that you are responsible for. And that's what we have in lesson 21.1. Not terribly difficult. You're just going to be recording them, and reversing entries is all you're going to be doing.